Hello, Andrew Faldy here with SMBU, and I'm going to show you some statistics to help you find edges in the market. So twofold purpose of this video is to show you the general tools, some methods for finding and quantifying edges, and secondly, a very specific edge in the market that you can see from this data here. So you can see this is a large spreadsheet. There's a lot of data here. 10 years of daily data, scrolling all the way down here you can see, of the Russell 2000. This could be repeated on any major index as well as any individual stocks, futures, forex, etc. But we're just using the Russell 2000. That's something that I focus on and trade frequently. And what I'm doing is I am trying to find out the 10-day probability cone. You'll find often in brokerage platforms and software for analyzing stocks and options, you will find probability cones that you can put on your charts, and this gives you an estimated range to expect price to stay within, all things being equal. So what I'm looking for is I want to compare all things being equal to when all things are not equal. So that means I'm adding conditions. And when I add certain conditions to the data, I'm looking for certain market conditions, certain oversold or overbought conditions in the market, and I want to see how does the data change, how does the probability change over time in that. So to give you the short version of this, what I'm looking for is the expected 10 bar, so 10 daily bars, probability, and I'm looking for, let me just confirm because I've looked at a couple different versions here. Move this over so you can see. I'm looking for the 10th percentile up to the 90th percentile. So we're getting that 80 percentile range, and I also have in here the median, or the 0.5 percentile of moves, and then that's plotting it out. And this gray line here says, there's this gray cone that shows day 1 through, or bar 1 through bar 10 on the daily chart, and it's showing this gray upper line, gray middle line, and the gray lower line is every day, every condition, all things being equal, our baseline test, saying day 1, what does the next 10 bars typically look like, and I'm measuring this as an ATR basis. So as volatility changes, as the typical moves from day to day change, higher volatility environments, the index at one point was in the 600s and then it's up in the thousands. So I want to just normalize that. Instead of number of points or a percentage change, I want to use a number of units that normalizes based on volatility. So I use ATRs. Standard deviation also works as well. So I'm using what is the typical number of ATRs that the market moves 1 day from now, 2 bars from now, 3 bars, all the way out to 10 bars from now. What's the typical median move? What's the 10th percentile, meaning 90% of the time, or 90% of the time we do not exceed that to the downside. And what's the 90th percentile of price, which means 90% of the time we do not exceed that to the upside. So in that range would give us 80% total. So I have a lot of information here inside of that. So you can see, all things being equal, the next bar, typically 1 ATR. Let me zoom in just a little bit more. See how clear I can make this. All right. So we have the next bar, 1 ATR up, 0.99 technically, and 1.21 ATRs downside. And then that goes off into 10 bars out up to 2.89 ATRs to the upside, and it looks like 2.76, somewhere right in there. So that is the probability cone. 80% of price moves should be calculated based on, and this is using the closed ATR. So the most recent ATR figure we have, so I'm not assuming that I understand how ATR changes through this period. I'm just using the ATR before this information and then measuring the moves to the outside. So that's the gray. The yellow, actually let's talk about the blue next. The blue is if if we close one ATR below the 9 exponential average. Why did I pick those numbers? I just want to pick some numbers. I could have picked a half ATR below a 5 simple moving average or all these other. I'm just looking for when price spikes below the mean. So the market has sold off, because that's something we've seen recently. So that's one reason I'm looking at this specifically, saying if the price of the market spikes below the moving averages, a short-term moving average, something that would smooth out price, what can I expect is the difference in probability of movement over the next several days? My assumptions when I came into this were there should, over time, be a little bit more upside in the market. There should be less downside, more upside. What did I actually learn? I actually learned that I was about half right. The downside, you can see here in the blue, actually remains very constant. Very close, very tight cluster around all the data points of any condition in the market. The upside, so you can see our gray line here is very flat, very smooth, just a minor edge to the upside to a little bit more upside, and that's just the nature of a rising market over a decade, typically rising. We see the blue line is just a slight bit more edge over the next 6 bars, 7, 8, 9, all the way up to 10. About a third of an ATR over 10 bars, a little bit more upside, statistically speaking. That I expected to see. What I'm surprised to find is that it's a minor difference on the downside. And then what was more interesting is that the upside moves were actually more pronounced than I expected. So the upside potential in the market really increased from day one, about a quarter of an ATR, and then all the way out 10 bars later, a little bit less than 1 full ATR, which an ATR would be several points in the market, so that would be several points of potential upside. So here we see when the price spikes below moving averages, in this case 1 ATR, it closes 1 ATR below the 9 exponential average, that the expectation of price over the next 10 days, 10 market days, would be about the same amount of downside, slight bit more on the median. So all data compiled together, the next 10 bars you'd expect to see just a slight bit more upside as far as the median of all the data points. But there's many times that we can see the market really move a lot to the upside. So there's more upside when the market spikes down, but there isn't actually less downside in the market. The downside stays about the same. The upside actually increases. So that's very interesting bit of information. Then this yellow line here is I actually used a 2 ATR spike below the market, which now we're getting into circumstances where there's a lot fewer data points to use, because that's a big move in the short term against short-term moving averages. But however, when that happens, we see a very similar thing happen yet again, that the downside stays very similar, actually starts to increase. So this is an overall volatility change. You would expect to see more volatility in either direction, but the downside yet again stays similar, very consistent compared to all the data points, but the upside really starts to get pronounced to the point of actually 10 days out, more than 1 ATR of potential upside on those bigger bounces, those bigger moves. So this was a lot of data points put together, a very simple filter in the market, but the way this is written, you can do this in Excel. You just have to get price data from the market. You can calculate the indicators if you want. You can actually export indicator data as well from some platforms. But get all that information into a table, some sort of spreadsheet, Excel, Google Docs or something similar, and you can start to write these conditions. So here, so now I'm just kind of showing the math behind it. So here was the first, this is all of the very basic data here. So this is the date, end of day data, so 1600 on the 24-hour clock, the bars, And then over here we have momentum. So I have a couple of indicators in here. And then I start to look at conditions. That was a different study I did. And then off to the right here is where I actually have this current study. So my information says if, so you can see the formula here and the cells that it's referencing here. So I can draw this out just a little bit. So it says I'm looking at the close, the change of tomorrow's close from today divided by the ATR. So I'm looking at the close. So what is the change in price from today to tomorrow divided by the ATR that is already closed, that information that I already have. So that's the one. Actually, this was the 2-day move here. Let me just check that over here. Yeah, that's the 1-day move here. So that's a quick example. There's a lot of different things you can pull in here. I can start looking at simple moving averages, standard deviations, momentum indicators, other types of overbought and oversold indicators. Another study I've done is just based on the current ATR of the market, or the current standard deviation, current implied volatility, etc. As implied volatility increases, you expect to see larger movements in the market in either direction. So all that information can be used for sizing data, etc. So that's just a quick example of using market data to find edges in the market. Here we see a slight edge that when market becomes a little bit oversold in the short term, that the upside potential increases. It doesn't necessarily mean there's less downside, but there is certainly more upside in the market. So using option strategies, discretionary trading, etc., using that information, you can see here slight edge to the bulls when the market has a sharp sell-off. But we can always pull in more data, use individual sectors, stocks, futures markets, etc. You can start to pull in correlations, pairs trading, statistics, etc. All kinds of fun that you can have using market data and analyzing it. So if you have any questions, send me an email, afaldi@smbcap.com. If you'd like to have me run a different type of study, or you have an idea of a study that would be interesting, let me know, and I will put it on my list. And if I start to see a lot of people asking for similar things, I might go ahead and pull that myself and share that with you. So that's it. Hope you enjoyed the video. Look forward to your feedback. Thanks a lot.